Hi everyone, I hope you guys are doing good and welcome to another episode in the payment series. Coming to my channel for the first time, make sure that you hit the subscribe button, like the content. If you see this video as of some use, then please make sure that you hit the like button, and also please share this video with your friends and colleagues who can benefit out of it. Another important thing that I wanted to mention here is that once you are done watching this video, in this video we're going to talk about what is DeFi, what are stable coins, what are smart contracts, dApps. At the end of this video, when you're done watching, you can go to the website, which is ezeefied.com. There are a series of questions that will test your knowledge on DeFi. Okay, so it's a good way of just making sure that whatever you have seen in this video has been understood well. And what happens here in decentralized finance is that we do not give the authority to a central agency or an exchange to facilitate the transactions. It's all on the network. Everybody can see what is happening, and that's the beauty, and that's one of the core principles of blockchain, right? It's all transparent. It's all there on the block, and you can see. Okay, everybody is anonymous, so you don't have your names and email addresses or anything of that sort, or any of the personal identification details. However, you have been given an address through which it's been recognized that you are one of the players in this particular transaction, and everybody can see who are the players in that particular transaction. Okay, so that's the whole concept of a fundamental transaction that happens on a blockchain. Now, DeFi is actually decentralized finance. As I said, what happens here is that this is exactly the same sort of concept as you would have in traditional finance, in terms of the players and the overall transaction, how it goes. The technical aspects are different because this is blockchain oriented, but other than that, fundamentally the whole thing still remains by and large the same. Now, when I say by and large the same, what I mean is, if you have ever actually come across a transaction in a traditional finance world, say for example, if you have invested in a fixed income bond, yeah. So what really happens is that you have to invest some money over there with a particular firm or institution or government, and that particular firm or institution or government will tell you that I will give you 5%, 7%, or 8% of the interest per annum on your principal amount. Okay, that's the whole way of how the traditional finance works. The same thing works for DeFi as well. However, the difference here is that there is no such regulatory firm, so to speak, or there is any exchange, right? So, for example, if you talk about traditional finance, you deal with things like exchange traded funds, or maybe some other kind of funds, right? Hedge funds. Here in decentralized finance, what really happens is that you do not have intermediary bodies. Okay, so it's all on the blockchain there. DeFi by and large is actually Ethereum driven. Okay, so there are multiple blockchains available. Of course, we all know Bitcoin. That's one of the first and the primary blockchains, and then Ethereum is another blockchain, and there are some others as well. Now, Ethereum is the one where most of the DeFi applications work on. The applications that use DeFi as the principal to work, they are called as dApps. DeFi applications, in short, we call them as dApps. So here are some key points that I've also mentioned about what DeFi is. So it's an alternative, as we have already discussed, to the financial system, the current financial system. It's free of intermediaries. Transparency is the key here. I've already discussed. Reduction in volatility is a very important point of why DeFi is gaining a lot of popularity. There was a downfall and Bitcoin crashed big time. A lot of people lost their money as well, and that is one of the things that was identified as one of the problems with crypto. When a traditional transaction happens, when you invest in a security which is interest rate driven, for example, you know that the interest rate is fixed and you would get X amount of money, right? For example, if you are investing in any of your government bonds, right, any of the securities that are being issued by government. For instance, if you are in India, then you would have bought a Kisan Vikas Patra, or you could have invested in some of the government schemes. You know that the government will give you the fixed amount after maturity, right? So let's say at the end of 3 years or 5 years, you know that this is the amount that will be given to you. So there is less volatility over there, right? When we talk about traditional finance, where do we see volatility? We see it in share markets, for example. That's again a very, very volatile market, right? But crypto is actually even more volatile, and the kind of crashes that happen in crypto and the kind of ups and downs that happen in crypto is actually not good for anyone who's investing his hard-earned money and expecting some returns. Okay, so when it was identified that there is a fundamental flaw here, and the people are kind of losing their money and their money is at risk. And it's the thing over here is that anybody who knows how a blockchain works and is good in programming and is aware about the principles of blockchain can actually go ahead and invent and create his own coin or invent some kind of cryptocurrency and put it on the blockchain. So the regulation part is still something that is improving, and that's where I think we have to be careful. We have to understand that regulation is something that is required. Now, again, it's like drawing a balance. I mean, it may sound like it's a bit contradictory to say that on one side we are saying that crypto is a highly deregulated market, and it's more like there are no intermediaries, so we want sort of a democracy here, right? But that said, then again on the other side we are saying that we need some regulations. And what I mean by regulations is that we want to make sure that there are no malpractices that happen here, right? So that's the whole intent. So for example, if some company puts in their coin, some stable coin, for example a USDC or a USDT, are there sufficient checks done by the agency? DeFi, what it does is that it says that if you are too worried about the ups and downs in investing in a crypto market, then if you have a blockchain amount, if you have invested in blockchain, for example Ethereum, you can actually get some interest on your investment. There are multiple ways. Either you can get the direct interest on your money, or you can convert your money into some sort of a USD equivalent currency and then get interest on top of it. So that was again the volatility reduces. Okay, so that's the important part that we have to understand. Pseudonymous transactions, we already discussed that we don't need to disclose the names. There is just a block address that's required for sending and receiving the money. Faster rates and rewards, yes, of course. The interest rates also, they change rapidly here. There are both pros and cons of investing into DeFi that one has to be aware of. Now, there are multiple ways of how you can actually engage with a DeFi. You can actually go for something like a lending. You can go for a loan. You can trade. You can have savings and interest, or derivatives, right? If you actually look at these terminologies, these are not new terminologies. These are not terminologies that have come in only when cryptocurrency came in, or only when Bitcoin or Ethereum came in. We have been knowing about these things since ages, right? We have all taken loans, so we know what a loan is. We know what lending is. So for example, if you have invested in a government bond, you have basically lend your money to the government, right? The government says that I need money to do some infrastructure upgradation work in the country or in the state. And therefore, if you give me the money, I would use that money to do the development work, and at the end of the maturity period, I will give you some interest along with your money back, right? That's the whole principle of how a lending market works. A very, very basic example. The same thing happens here as well, but the only difference is there is no government. There is no multi-corporate or a corporation that is saying that give me your money and I'll invest it into my business and I'll give you some return back. It's all blockchain driven. Okay. Similarly, trading also, you can do trading as you would do on an exchange. You can just do it over here as well. There is when I did some more research on, and when I was reading a little bit more about how the DeFi market has been evolving with time, they're trying to sort of rationalize everything with the typical traditional market. But like I said, they also understand, they also know, and everybody knows that the whole reason why somebody would come to an application like a DeFi would only be because he wouldn't be interested in into a traditional finance system where somebody takes the whole control of the process, right? So that's more like a democratic process of investing your money. For example, let's just say that there is a company who says that I'm going to invest into a new stable coin. Okay, it makes a new stable coin for you, and it says that this stable coin will be pegged at the value of a US dollar. Okay, what it basically means is, when we say that a stable coin is pegged at the value of a US dollar, what it basically means is that the value that you get when you sell that coin will be equivalent to the value of a US dollar. So you do not expect too much of fluctuation. It shouldn't be that your value just gets reduced by half the other day. That normally doesn't happen with strong currencies like US dollars, right? So what really happens is that if you say that I will buy 100 of your stable coins that are pegged against US dollars, you are kind of assured that tomorrow when you want to sell those 100 stable coins, you will get the money that is equivalent to 100 US dollars back. What if you don't get that money back? Who owns the liability over there? There is no government over here. There is no corporation over here. So who's going to take the responsibility if you lose your hard-earned money? That's a big question, right? And therefore it becomes important that there are some audits, some checks being put in place so that nobody just takes the whole thing for granted. So there are some companies, for example Circle, for example Coinbase, they come up with their own coins with time, right? For example, there's a coin called Tether that will come in. There is a coin called USDC that has come in. When you buy these coins, you get that confidence that your money is safe. There is nobody who is going to take your money away. And how the audits are being done is that there are certain agencies who will actually make sure that these companies have got enough US dollars, the real US dollars, not the stable coins ones that they're selling it to you, but they do have real US dollars either in the form of currencies, cash, or bonds invested somewhere, so that in case if you want your money, you can get it back. There is an assurance given. Okay, so that's the important bit that you have to understand. Also understand some of the traditional differences between traditional finance and DeFi. These are some differences that I feel you should go through. Some of them we have already talked about, but I've just put it in the slide so that we can just go through them in a single view. And this will help you to develop that mindset of looking and comparing between the two sides of the financial world, the traditional finance versus the crypto. So you hold your money in the DeFi, whereas your money is held by the companies, right? Because there is no intermediary company or any organization here in DeFi. So you as in whoever are the people who have invested in the blockchain, they all are got sort of the shareholders here. Now you control where your money goes and how it's spent. The entire control lies with you. Whereas when you invest with a corporation, it's the corporation or the companies who are going to manage the money on your behalf, right? So you give your money to them, and the only thing that you care about is that at the end of the maturity, I want my interest and my principal back. But what you do with my money is something that I don't care. So that's the kind of thing. Transfer of funds happens within minutes. It's very fast. If you have actually not done a transaction, you can try that yourself and see. What I'll do is I'll leave a link in the description of the video where you can actually create an account on crypto, on Coinbase, where you can create an account on Coinbase. You can use the link that I have put in the description. So you will also get some crypto to start investing with. Okay, and that's absolutely free. You can just go ahead and register yourself. So you can transfer the funds yourself, and it's very fast. But in traditional finance, the payments might take longer. Again, we also discussed that we don't need to disclose your personal identification details on DeFi, whereas in traditional finance, there's a lot of emphasis on things like KYC and stuff like that. So we want to make sure that all of the transactions and all of the people who are investing the money are being audited well. Open to anyone. But here on the other side, you have to apply, right? So you have to apply for investing in a bond, and only when the sufficient checks are being done and you have your account created, and only then your investment begins. Markets are always open, so you can do it any time of the day. Pretty much the blockchain runs around the clock. So there is always an option of taking your money out or investing in, getting in. That's another thing which happens on the DeFi world. But on the traditional finance world, we only work on hours because obviously everybody needs a break, and we have to shut down the offices and come back next morning. So it always works on a 9 to 5 kind of a model there. Transparency is the key on the DeFi. Like I said, that's one of the major principles of why DeFi is becoming so popular, because it's all transparent, it's all there on the blockchain, and everybody can see what's happening. But in the financial institutions, they are like closed books. You don't really know, except for the transactions that you should be knowing, which is something like your monthly transactions, or your portfolio based transactions that you should be aware of. Other than that, you pretty much don't know. For example, let's say if you have invested in a mutual fund, right, and you invest 20,000 rupees every month, or 20,000 US dollars, or whatever the amount is, every year or every month, in a particular investment. Now, when you invest this money, all that you are caring about is that whether this is reflected in your account or not, whether you can see those transactions in your statement. But how the fund manager is going to use this money and then invest it further, you don't really know, and you don't really care about it as well, right? So that's the thing, which is actually different here. Okay, we have looked into DeFi. We kind of understand how DeFi works. Maybe I think it will take some more time. So I would strongly advise you all to read a little bit more about DeFi if this is something that you are hearing it for the first time. I'm sure many of you have already known about it, and maybe you are knowing more than what you have discussed in this video. If at all there are certain things that you think that we should be covering more, then please do leave a comment so that we can pick them up and create some more content on that down the line. Disadvantages of DeFi. Now, the other side of the coin, right? That is not that glowing, is that it's a fluctuating business. Okay, we all have to understand that crypto, no matter what, is a highly volatile area. It's not for people who do not are not ready to take any risks with their money. So that's why they say that it's only a small proportion of your total asset value that you should be investing in cryptocurrencies. Maybe DeFi gives you that leverage a bit more, and you can sort of expose a bit more. But then still, it's a new area, right? And not everybody is ready to kind of get into this area. So be aware of that fact. Ethereum is what is being used. The other than the fluctuating nature of the market itself, the transaction itself can be costly. So every time you do a transaction worth say $5 on Ethereum, yeah, you have to pay a transaction fee. It's basically, they call it as Ethereum gas fee, or something like that. But basically what it means is that every time there is an operation that is involved on blockchain, you have to pay a fee associated with it. Now, that fee can vary. Okay, that's not fixed. Okay, so if you are investing, you have to make sure that you get the best price. So sometimes it can be low, sometimes it can be less. So all those things. Many people go with the concept of dollar cost averaging. What this concept says is that rather than making a big bang investment, you break down your investment into smaller chunks and keep investing regularly, so that you can better absorb these shocks and you can get the maximum value out of your investment, maximum return out of your investment. So it's still a very relatively volatile area. And taxation is a bit tricky because obviously there are not too many regulations here. So you have to make sure that you report your transactions promptly for taxation purposes. Now, very quickly, let's understand this important concept of a smart contract. Now, smart contract, the name may sound fancy, but there is nothing new in this term. I mean, it's basically the concept where we are saying that if you want to execute a transaction on a blockchain, certain conditions need to be met, right? What could be those conditions? Simple conditions: whether the user has the required amount, has the user paid the required amount of the gas fee or the additional transaction fee to run the transaction on the blockchain, etc. And anything that goes by that particular product or that application on DeFi, right? So whatever the DApp application is, whatever the concept of that application is, depending upon that, a contract will be written. How do these smart contracts work? There is no human being involved in the transaction. There is no company or an organization involved in the transaction. So how do these smart contracts work? Well, the concept is very simple, that we write everything in a piece of software. A computer program is written, and we write all of those conditions, pretty much like an if-else condition If you are from a computer programming background, you would know, right? When you beat any language, when you have to do something conditionally, you have a certain set of statements like if else blocks, and you can say that, if this particular condition is met, do this, else do that. Something of that sort goes into a smart contract, and there are different languages that you can use to write a smart contract. When you have written this and when you have put that on the blockchain and stored it on the blockchain, this smart contract is executed when those preconditions are met. Very, very simple concept, nothing complex in that. Okay. Further, they can also be used to automate some workflow. So for example, when this particular transaction is completed, you additionally also need to do something else, right? So that's where you are enhancing the workflow. The workflow ended where the transaction got completed, but then you want the workflow to now to move on to something else and do something else. So we don't want to do any manual intervention there. Rather, the contract will drive everything because it's all on the blockchain and it's all on the machine. Therefore, just a program is required. I'll give you a very, very simple another example to understand the smart contract, which is buy a coffee from a vending machine. Maybe not from your office, but let's say from an airport or from a railway station. You have to put in the required amount of money, right? Either you swipe your card or you put some coins in the machine. The machine knows exactly how much the amount it needs to collect from you. So let's say if you had put in coins worth $2 and your coffee is only for 150, you are expected to get 50 back, right? 50 cents back. So in that case, what happens is that the machine will understand that, will do that, make your coffee, give you the coffee, and give you the 50 cents back. And that is all done without the need of a human being. It's all automated, right? And I know the outcome of this transaction. I know that I should get my coffee and my 50 cents back. The machine knows that it needs to keep the amount that is required to buy the coffee and then give the remaining back. And along with that, it has to also give the coffee back. So, the simple way of understanding a smart contract. So that's how the smart contract works. Okay, and this is one of the fundamental principles of DeFi, because whether it's traditional finance or whether it's a DeFi based finance, it's all about driving the contract forward, right? For example, if it's a fixed income security, again, I'm giving that example so that you can correlate and understand it. Know that at the end of the maturity, the government is expected to give you this amount because there's a contract that's been drawn. It says that you have to get this. Let's say if it's a zero coupon bond, like for people who are from the finance background may understand that. If it's a zero coupon bond, you know that at the end of the maturity, you are going to get this amount back. For instance, if you are in India and you buy a zero coupon bond or something like that from a post office, right? Wherein you say that, okay, I will buy this particular bond from the post office. The post office, while issuing the bond, will tell you that at the end of the maturity, this is the amount that will be given to you. It's mentioned on the script, right? And we know that this is the amount. It's a contract that's been drawn, and unless the government defaults, unless the government of the country defaults and is not able to pay, there is no sort of risk that I see over there, because there is a contract being drawn, and the contract and the risk taking, the risk lies with me as the person who has invested, but the party who is actually going to borrow the money from me is actually the Indian government or a sovereign, which actually wouldn't go down. Right. So I unless there is a very, very, unique thing that happens. So that's where I think smart contracts also work in a similar fashion, where on the blockchain, everything is being done as per principally agreed upon. That when this condition is met, I will do this. And that's it. The transaction gets executed. It wouldn't be a complete discussion on DeFi if we don't talk about stablecoins. Now, stablecoins were actually created to bridge the gap between fiat currencies, which is your regular currencies like US dollar or GBP, and the cryptocurrencies. Okay, so what was the gap here, right? Why do you need a stable coin when there are already fiat currencies which you can use and invest into cryptocurrency? It was basically because of the nature of and the volatility in the cryptocurrency markets. The mobility of the fiat currencies was an issue, right? Every time you had to pump in the money into blockchain, you had to do some transaction, get the money inside the blockchain, pay the additional charges that you would, apart from the price of the transaction, apart from the transaction value, the additional price that you need to pay. All of those things basically were an issue when it came to circulating the money and you get things moving faster on the blockchain. And it was therefore required that there has to be a concept where using your money wouldn't be a problematic thing, so it should be a smooth process. Now they created this concept of stable coins, wherein what they are saying is that um, it's as good as your fiat currency. It's exactly the same thing. um, I wouldn't say exactly the same thing because obviously these are two different assets, but fundamentally the intrinsic value of a fiat currency or a stable coin should be the same. If I have 20 US dollars worth of fiat currency, or I have 20 US dollars worth of stable coins, they both have the same intrinsic value. I can use either of them, but when I'm doing transactions on blockchain, it's easy for me to use these stable coins. So that's kind of like the concept behind that. Okay. As you can see on the slide here, there are multiple different types of stable coins that are being mentioned, but essentially the value is pegged against a stable currency or an asset like US dollar or gold, right? So as it's kind of like a concept of a derivative where the value actually changes with the value of the underlying, right? So it's kind of like the same concept, but you have to understand the different kind of stable coins. So fiat backed is what we just discussed about, where the asset is actually the US dollar, right? So as the dollar value changes, the stable coin value associated or pegged to that US dollar would also change. Then the second type is your crypto backed, wherein the value changes based upon the value of the blockchain. So for example, if it's something which is so basically the concept is still the same, but instead of a US dollar, it would be, the value would be driven through the value of Ethereum, for example, right? So as the price of Ethereum will change on a daily basis, the value of your stable coin associated will also change. The commodity backed is again depending upon the changes of the price in precious metals like gold, or it could be oil, or it could be real estate. So as on how the price market fluctuates, you would see the value of these stable coins also will change. And algorithmic are certain algorithmic based stable coins where there's a certain specialized blockchain based algorithms and smart contract, and these basically derive the value of these stable coins. Now, I have a question for all of you. What do you think is the best kind of stable coin according to you? Where would you put in your money? Which stable coin would you opt for out of these four? Leave me a comment and let me know what your thoughts are behind that. So guys, the last topic that we want to cover on this video is dApps, or simply decentralized applications. Any application that uses or leverages the concept of DeFi is basically simply called as a dApp, right? So they feel like regular applications, but they derive all of their power from Ethereum. There are no owners to these apps. So what basically it means is that if it's deployed on Ethereum blockchain, and that's where they get deployed, there is no way you can take the code down. Once it's gone on blockchain, it's gone, right? So there is no sort of owner for that code then. There is a built-in payment integration because it uses Ethereum ETH, so you don't need to have separate payment integration. Again, it's a plug-and-play process. This is all blockchain driven, so the code has been written in a way where it's all easy and plug-and-play is possible. Okay. Again, blockchain based, so anonymous logins is possible, and there is no downtime. Only time when the dApp application is down is when the Ethereum blockchain itself is down. Okay, so very, very simply put, these are some of the salient features about dApps. Now, what I will strongly recommend you here is that if you are new to dApps, you can actually experience this yourself, and that is the best way to understand dApp. Okay, it's very, very easy. You can simply again go to Coinbase, install their wallet on your phone. Okay, there is a separate application for Coinbase wallet. Install that on your phone, and you can simply go ahead and start using a dApp. Okay, maybe you can use something like an Aave. There are multiple dApps. Some of them could be for swaps. Some of them could be for getting yields or interests on your investments on Ethereum, for example. You can even buy US dollars coins as well and you can do multiple things there. And that is where you can actually get a taste of how DApp works. Now, as I told you, you can actually learn some basics about blockchain and some of the other cryptocurrencies and get some free dollars earned on Coinbase. And what you can do is you can use those dollars to start practicing about dApps. Now, the only flip side here is that the amount is not big enough so that you sort of see some interest rate flowing into your account. So basically, all of the transaction fee itself is high, and it sort of offsets the entire interest. So, but it's a learning exercise, right? So we just want to learn here. So I'm just trying to see, without spending too much money, how you can go ahead and get a taste of how DApp works. So give it a go and see how it works for you, and then we can take up any questions that you have in the comment section. So with this, we come to an end to this video on DeFi. If you like the video, please do consider it sharing with your friends and colleagues. Also, if you are new to my channel, I will request you to subscribe my channel and encourage me to make more such content for all of you. And do also like the video. All right, so with this, I will take your leave and I will see you all once again with another exciting video. Thank you. Take care.